Stocks pushing to the upside today as the S&P 500 comes off its best week since November, where we are trading right now above 5,100, which is about 3% shy of record highs. Well, despite that move to the upside, though, our next guest is warning the equities may be set to actually lose momentum from here. We want to bring in John Kolovos, Macro Risk Advisors, Head of Technical Strategy. John, it's great to see you. So you have a number of charts that we're going to be putting up here in our monitor that you are going to break down. But first, just talk to us just about the momentum that we're seeing play out in the market. We've seen the S&P break above that 5,100 level. Doesn't sound like, though, you think we're going to remain at these elevated levels. Why?
Yeah, thanks for having me. So first things first is, it's the nature of how the market declined that has me a little bit concerned. When the market peaked in early April, it started to have this cascading event of selling beget selling. And what I mean by that is if you take a look at some of the high profile winners, the momentum winners, the semiconductors, for instance, once those stocks started to break their 50-day moving averages, a bit of a trap door occurred in equity markets where what would be a conventional oversold condition where you want to be, okay, let's buy this and keep getting aggressive. I would almost label it as a bad oversold because selling was a little bit too aggressive on the downside.
Well, let's talk about that downside. And we have a chart here on the corrective pullback with risk to 4,800 that I wanted to pull up for you here, John. I'm curious if you can speak to what we're seeing in this chart when it comes to the potential risk for us to get back down to 4,800 here and what the catalyst might be to push us down to that level.
Sure. So basically what I'm outlining in my notes to clients is that I believe that we are in a correction. This is not a bear market, right? This is just a corrective process. In a lot of ways, you can kind of think of this as the market's working out their excessive bullish sentiment from the beginning of the year. Also, from a seasonal standpoint, this part of the election cycle from mid-April to about June, markets tend to pull back. So kind of par for the course-ish. But like I said, the decline that we saw in April was accompanied by a lot of heavy volume. So what typically transpires is called an ABC correction. A is the initial decline down. B is the oversold rally, which is where we are right now. And then finally, you get the C wave lower. And that C wave lower is where you truly get folks bearish, right? You really see the whites in their eyes. Some of the sentiment data that's been released during this month has gotten better, but I wouldn't go so far as to say that it's really showing signs of capitulation quite yet. In terms of catalysts, I have my eye very, very much closely on what's going on with the Fed and these hawkish macro trends that have been going on all year.
Yeah, John, is that the number one thing you're watching just in terms of sentiment? What exactly is going to be that catalyst from here? Is it what comes out from the Fed and any sort of hints that maybe rate cuts are still on the table for this year?
Yeah, I mean, I tend to focus a lot more on that macro end of things where I try to triangulate my equity call, right? So because if equities lived in a vacuum, it would be a much easier call, and they don't, right? They interact with interest rates and commodities and currencies. And those trends have been negative all year for risk. And it just happened to be the CPI number when the 10-year broke above 4.5%, markets went, oh, wow, maybe we should pay attention to this. And I think that was a regime change in terms of market psychology. So yeah, I am keeping a very close eye on how the market responds to the Fed this week. We also have important economic data as well on the jobs front. We do have earnings. Also, there's a couple of Mag 7 stocks that are coming out as well. But unless we see the S&P and most of the major indices see a sustained move above the respective 50-day moving averages, at a minimum, expect an undercut of the April lows. If not, a move down to 4,800. Which is approximately where the 200-day moving average is trending towards.
All right, so watch that 50-day moving average and hope for the best for our investors listening. John, thank you so much for joining us. That was John Kolovos, Macro Risk Advisors, Head of Technical Strategy.